S&P 500. The S&P 500, or Standard & Poor's 500, is one of the most widely followed stock market indices in the United States and serves as a key benchmark for the overall performance of the U.S. equity market. Here's a detailed overview of its structure, history, significance, and more. 1. Overview and history. Established. The S&P 500 was introduced in 1957 by Standard & Poor's, a financial services company that is now part of S&P Global. Objective. The index was created to provide a comprehensive measure of the U.S. stock market by representing the performance of a broad array of large-cap companies. 2. Composition. Number of companies. The S&P 500 consists of 500 of the largest publicly traded companies in the U.S. It includes a diverse range of industries, ensuring a broad representation of the U.S. economy. Selection criteria. Companies are selected based on market capitalization, must be at least $13.1 billion, liquidity, and other factors like financial viability, sector representation, and growth potential. The index is maintained by a committee at S&P Dow Jones Indices. 3. Market capitalization weighted index. Calculation method. The S&P 500 is a market capitalization weighted index, meaning that larger companies have a greater impact on the index's performance. This is calculated by multiplying a company's stock price by its total number of outstanding shares, resulting in its market capitalization. Impact of large companies. For example, significant movements in the stock prices of major companies like Apple or Microsoft can heavily influence the index due to their larger market caps. Sector representation. Diverse industries. The S&P 500 includes companies from 11 sectors as classified by the Global Industry Classification Standard, GICS, information technology, healthcare, financials, consumer discretionary, consumer staples, energy, utilities, materials, real estate, communication services, industrials, balanced view. This diversity allows the S&P 500 to provide a balanced view of the overall market and economic conditions. 5. Significance and uses. Market benchmark. The S&P 500 is considered a leading indicator of U.S. equities and is often used as a benchmark against which mutual funds, ETFs, and other investments are measured. Investment strategy. Many investors use the S&P 500 as a basis for constructing their portfolios, often through index funds or ETFs that track its performance. Economic indicator. The index is closely watched by analysts and economists as a barometer of the overall health of the U.S. economy. 6. Performance measurement. Total return. The S&P 500 is often evaluated based on its total return, which includes both price appreciation and dividends paid by the constituent companies. Historical performance. Historically, the S&P 500 has provided an average annual return of about 10 to 11% over the long term, though this can vary widely in shorter time frames. 7. Comparison with other indices. Versus Dow Jones. The S&P 500 includes 500 companies compared to the Dow's 30, providing a more comprehensive view of the market. Unlike the Dow, which is price-weighted, the S&P is market cap-weighted, allowing it to better reflect the overall economic landscape. Versus NASDAQ. The NASDAQ composite is heavily weighted towards technology and growth stocks, while the S&P 500 encompasses a broader range of sectors, making it more representative of the entire U.S. economy. 8. Recent trends and developments. Growth of index funds. The popularity of index funds and ETFs tracking the S&P 500 has surged, making it one of the most commonly held benchmarks in investment portfolios. Impact of major events. Major economic events, such as the COVID-19 pandemic and resulting market fluctuations, have shown how the S&P 500 can be affected by broader economic conditions. The S&P 500 is a vital component of the U.S. financial landscape, providing valuable insights into the performance of large-cap stocks and the overall economy. Its structure and methodology make it a reliable benchmark for investors and analysts alike.